Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of primary market versus secondary market, key differences every investor should know. Buying and selling stocks or bonds relies on two key components of the financial world: primary and secondary markets. These markets support the economy by connecting businesses with investors and ensuring smooth trading. In simple terms, the primary market is where new securities are issued, while the secondary market is where they're traded after issuance. Understanding how these markets work is essential for anyone looking to make informed investment decisions. Understanding financial markets. Financial markets are where people and institutions trade assets, stocks, bonds, currencies, and more. They play a huge role in the economy, acting as the backbone of global commerce. Whether you're an individual investor or part of a corporation, these markets create opportunities to grow wealth, raise capital, and manage risk. But not all financial markets are alike. Let's break them down. Types of financial markets. Financial markets can be grouped into a few main categories, each serving a distinct purpose. Here's a closer look at the key types. Capital markets. Capital markets are where long-term investments like stocks and bonds are traded. These markets help businesses fund their operations and expansion. If you've ever bought shares in a company or a corporate bond, you've participated in the capital market. They are divided into two segments: primary market, new securities are issued directly to investors. Secondary market, existing securities are traded among investors. Think of this as buying a new car off the lot, primary market, versus buying it used from someone else, secondary market. Money markets. Money markets handle short-term borrowing or lending, typically for less than a year. They focus on liquidity and low-risk investing. Instruments like treasury bills, certificates of deposit, CDs, and commercial paper fall under this category. For example, businesses often use the money market to manage their short-term cash flow needs. Derivatives markets. Derivatives markets deal with contracts based on the value of an underlying asset. Common examples include options, futures, and swaps. These markets are often used for hedging or speculation. Here's an analogy. If the stock market is a grocery store for buying produce, the derivatives market would be the insurance you buy for your groceries in case they spoil. These categories of financial markets form the framework for economic stability and growth. Each one connects investors and businesses in its own unique way. Knowing how they function is the foundation for making informed investment choices. What is the primary market? To put it simply, the primary market is where securities are born. It's the place where companies, governments, or other entities raise funds by issuing new financial instruments directly to investors. If the financial market were a theater, the primary market would be opening night. Everything starts here. Definition of the primary market. The primary market is the segment of the financial market where new securities are created and sold for the first time. These securities come directly from the issuer, whether it's a business, government, or other organization, and are offered to investors. This is how companies raise funds to grow, governments finance infrastructure, or organizations fund their operations. In this market, the focus is on raising capital by selling equity, stocks, or debt, bonds, directly to buyers. Unlike the secondary market, there's no trading between investors here. The transaction happens directly between the issuing entity and the buyer, like purchasing a product straight from the manufacturer. Function of the primary market. The ultimate role of the primary market is to connect issuers with investors, enabling capital to flow into businesses or projects. Here's how it works. Capital raising. Companies looking to expand or launch new ventures issue new securities to raise money. Direct issuance. Securities are sold directly to investors, typically through underwriters. Price setting. The initial price of the security is determined here, often with the help of financial experts or institutions. For many businesses, especially startups, this is a lifeline. Without the primary market, finding large-scale funding would be a monumental challenge. Governments also use this market to fund public works or other priorities by issuing bonds. Think of it as a company getting a financial starter kit from investors before they move on to broader trading in secondary markets. Participants in the primary market. Several key players make the primary market function smoothly. Each has a specific role in ensuring that securities are successfully issued. Issuers. These are the entities offering securities for the first time. They could be corporations issuing stocks or governments issuing bonds. Investors. Buyers of the securities, which include individuals, financial institutions, and businesses looking to allocate capital. Underwriters. Financial intermediaries, often investment banks, that help structure and price the securities. They also manage the sale, ensuring compliance with regulations and a smooth process overall. Imagine a stage production. The issuer is the scriptwriter, the underwriter is the producer, and the investor is the audience buying tickets. Each part is critical in turning the idea into a reality. Examples of primary market transactions. The primary market is most commonly recognized through high-profile transactions like initial public offerings, IPOs. But other types of activities also fall under this market. Here are a few examples. IPO, initial public offering. A private company offers shares to the public for the first time. For instance, when Facebook, now Meta, went public in 2012, it raised $16 billion in its IPO. New bond issues. Governments often issue treasury bonds to fund infrastructure. For example, the U.S. government sells treasury bonds regularly to finance large-scale projects or reduce budget deficits. Private placements. Securities are sold directly to specific investors, like private equity funds, rather than the public. This is a more targeted fundraising strategy. Rights issues. Existing shareholders are given the opportunity to purchase additional shares, usually at a discounted price. These examples highlight the diversity of the primary market and its ability to cater to different funding needs. Whether it's a billion-dollar IPO or a bond sale to fund new roads, the primary market is where the financial journey begins. What is the secondary market? The secondary market is where the action happens once securities have been issued in the primary market. It's the platform for investors to trade existing securities like stocks, bonds, or other financial instruments. Unlike the primary market, transactions here don't involve the original issuer. Instead, it's all about investors exchanging ownership among themselves. If the primary market is where securities are born, the secondary market is where they live and thrive. Definition of the secondary market. The secondary market is a marketplace where previously issued securities are bought and sold between investors. Its main purpose is to provide a venue for trading securities after their initial offering. The issuer no longer receives funds in this market. For example, when you purchase a share of Apple, the money goes to the seller, another investor, not Apple itself. This market allows investors to exit their investments whenever needed and offers newer investors the chance to participate. Think of it as buying a pre-owned car. The transaction benefits the current car owner, not the manufacturer. Function of the secondary market. The secondary market plays a critical role in maintaining a healthy and active financial marketplace. Here's what it does. Provides liquidity. Investors can quickly convert their assets into cash by selling securities whenever they want. Price discovery. The market determines an asset's fair price through supply and demand. Real-time trading ensures that pricing remains transparent and competitive. Encourages investment. Knowing there's an active market to resell securities enhances investor confidence, encouraging more people to invest in the first place. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.